Okay, traders, lots to review, so let's just dive right into it. So this is the list of alerts that I sent out today, and it's quite a few of them. Why? Because we're finally up in a range where on daily time frames, we've got a lot of markets that have retraced, and this gives us opportunity to take advantage of a larger trend that I still believe is in place. So this morning I shared about 8 o'clock this morning Eastern. I saw a graphic today, and the parallel that I thought could be in play, I mean, the symmetry was amazing. Let me show you what I'm talking about. And this sort of set the tone for the morning before we even started. And that was this. This is an image that I found on the internet. And basically, this is the present Dow Jones versus the 1929 Dow Jones, the amount of the sell-off, the amount of this bounce before we go for another ride to the downside. And so am I saying that's what's going to happen? No, but if we're all sort of students of history right now, and that's what's happening, whether we're looking at '08 as a playbook, whether we're looking at '01 as a playbook, whether we're looking at '87 as a playbook, whether we're going back to '29, there's a lot of probably pieces of each one of those that we could consider applicable. But here's the thing. 29 is probably where a lot of traders sort of mentally are at in terms of the scale of the sell-off and the speed of the sell-off. And so, yes, it's not unrealistic to expect these really brutal bear market bounces. Now, one of the things that I put in the notes, just so you guys have just a feel for what's going on out there in terms of the conversation, and this isn't one I'm going to dive into because I think it's a nonsensical conversation, but we'll hear a lot of it. You know, secular versus cyclical. I mean, I'll tell you straight up, that's stuff for talking heads on television, right? And so it's a debate that happens on television. It's a useless conversation, I'll tell you right now. Because generally speaking, a secular market is one where you would step back and say, who has seen below average stock market returns for most of their adult life? Almost nobody. I can't think of anybody. It's a generational disappointing stock market return. Not just for a month or a week or a year. I'm talking a generational, and I don't think we've had that. And by the way, when you think about the weighting of the indices and the central bank intervention, it's almost impossible to say that we're not ever going to see anything but a secular bull as long as these markets can justify being under the sort of corporate and personal and even country type debt load and not caring about lower revenue from companies, the incredible amount of corporate debt they're under. And you know, look, we can talk negative about the market, but I could talk about these same negatives before the market made new highs. So we are in sort of this permanent secular bull, right? What's more important is cyclical. Cycles are the only thing that matters to us and really to traders and investors, not just to traders. We want to focus on macroeconomic cycles like I teach you in terms of GDP, inflation, monetary policy, and money supply. And a lot of you are seeing where, okay, Rog, I'm starting to see that it's not a matter of timing, but it's kind of a matter of what's the environment like out there? What's the playing field like? That's exactly true. Business cycles, debt cycles. Debt cycles, think Bridgewater and Ray Dalio. Even commodity cycles that are going to be very much hinging on the prior three. So we focus on cycles, let go of that whole secular versus cyclical. That's for people suiting up and heading on their television. Not something that's going to apply to what we're doing here, nor to your portfolio. Now, yesterday, in yesterday's premium video, I did a deep dive on how it is we tend to recover out of these things. You know, where do we tend to see the strength first? And I'll keep talking about this conversation. The 2008 versus 2020 playbook. Check that out from yesterday's notes. You can pause the video here real quick and read it if you didn't see it yesterday. But this is typically the order of recovery. And you want to focus mostly on high yield corporate bonds, Russell 2000, and even the emerging market. All right. And none of those are looking like buys right now. In fact, you know, I think you could probably make a justification on looking at shorting things like HYG and LQD, you know. So we're not anywhere near that basing of those markets for a recovery. So I've got that in mind for you guys as well, and I'll continue to talk about that Not from a stock picker standpoint. Gosh, that's not where you want to be. What stocks do you want to own when the market rallies? Leave that to chuckleheads on television. We really want to talk about what does a true base look like, and what sectors and asset classes does that basing begin in. This is going back to historical, true understandings of the market, gang. And that's what I want to help you all. And I think a lot of you probably can look back at those prior downturns and say, yeah, that does make sense, Rock. I saw that. I noticed it. I may not have seen the pattern, but that sure does seem familiar. And that's the familiarity that we want to sort of tap into, right? Not a stock picker's market, but rather, how do we know the basing begins? And we're nowhere near that right now. Case in point, for those of you that were looking at copper earlier in the week, and we'll come back to this list of alerts, but for those of you that were looking at copper and know that I've been wanting to short this is one of those markets where problematically there's no options on Thinkorswim or Tastyworks. It is not a cost prohibitive contract in any way, but the volatility and the movement can be a lot. But a lot of you are in your first copper shorts right now that I'll take overnight. Now, notice I'm focusing on initial margin overnight positions that are not cost prohibitive. This is roughly a $3,000 contract. I'm not putting us overnight into very high margin requirement contracts, because one thing that's worth mentioning here, and I mentioned in the chat room this morning, is when I put trades out and even sort of give you ideas of how many contracts to consider, I'm always going to do it in such a way that I sort of imagine that you're working with a $10,000 account. 10,000 is such a great number because it scales up and down. So if you're trading $1 million account, $100,000 account, a $50,000 account, when you know that I'm sort of the suggested serving size, if you will, is predicated on $10,000, right? So at that point, you can say, all right, well, I've got 20, 30, 40,000, and I can adjust the risk accordingly, okay? Like, for example, my husband's got a position in natural gas. This is one of the alerts that I sent out. And that natty gas short was with 3 contracts. He's got 3. I've got a multiple of that. I've got many, many more than that, but I've got a multiple of that I'm looking at through the actual underlying futures contract, as well as natural gas puts, as well as UNG ETFs. I'll spread it across a couple different asset classes, but I'll build a larger position because a larger account can take a different amount with a 2.5-3% sort of hit, right? Meaning, if I were to experience a drawdown, 2.5 to 3% for my husband's $250 to say $300, right? And then you would look higher with multiples of that if you had a $100,000 account. So to keep that in mind when you see the quantity that I share with you all. All right, next is, are we short copper? Yes. And if this is a market that's truly going to be rallying going forward, copper better participate. Crude oil better participate. These are the commodities that are what I call the canary in a coal mine commodities that really do reflect true risk appetite. If we don't have copper and crude oil participating in an equities rally, what we have are just stock market buys, stock market, euphoria, not necessarily the sort of foundation that would reflect true optimism about expansion, growth, etc. All right. So pretty telling that copper participated and then sold off today, gave us our fill. We're short copper. And some of you might say, Rog, I'm not in copper, or I'm in puts. That's fine. If you're not in copper at all, it's, again, like I said, one of those problematic markets where we don't have an alternative ETF and we don't with liquid options. So we don't have the ability to play with some leverage that market. All right. The other thing that I sent out was an interesting link about Warren Buffett and the yen. So that's just something to read. I like you guys to sort of be up to speed on different things that are happening in the market. So I'll share those links with you. And then by 8:35 a.m. Eastern, we knew that there was Australian dollar, New Zealand dollar strength, yen and US dollar weakness, which is classic risk appetite for stocks. We knew we were going to deal with a sizable gap up. So on the Forex side of things, I think those currency lineups actually worked out pretty well for intraday currency day trades. Now you'll notice from the alerts that I did not day trade the indices at all today. And the reason was there was that disconnect. Yesterday they were really nicely connected. Today there was a disconnect. We get this great big gap up. Now that brought up another conversation. And again, I kind of attack that in the notes, and feel free to check that out. So whenever we have this sort of move higher, questions are like, what are the rules of a gap open? What are the different scenarios? So I kind of gave you guys a difference between sort of this idea that you can gap up or down and go versus a gap fade, where the market gets the gap, doesn't do much with it, and might chop or even sell off after the gap up. Now, there's no like blanket way of saying, you know, this and this and this happen, it's a gap and go, and if this and this and this happen, it's a gap fade. But there are certain probabilities, right? So the size of the gap is what gets our attention, as I've written here. And then whether or not we get that opening drive. Now, this is just sort of the jargon, the lingo of intraday trading, especially as applies to gaps. If there's this momentum, this opening drive with a strong market internal, mostly your advanced decliners and your ticks, you'll typically see the market might be able to gap and go, continue in the direction of the gap. Now, if the market internals are not necessarily supporting that, we might end up range bound. And then the third alternative is the gap fade and then the fill of the gap, right? So the bottom line is, if we're going to see a gap and go after a large gap up like today, if we're going to see that continuation, you've really got to take out the overnight high. In other words, that high that occurred after 4 p.m. Eastern the previous day, but before 9:30 today, you want to take out that overnight high. And what you're typically going to see from 9:30 to 10 o'clock in that environment is a tick that stays strong and steady, and an advanced decliner that stays typically above 1,000, but I would even say 2,000. So you need to see that kind of steadiness during the clearing, and ideally you see that the overnight high is taken out. If that doesn't happen, if we don't see kind of a clear overnight high breach, you're probably going to have sort of a choppy market and or a choppy market that ultimately sells off, which is really what we've seen here today. So take a look. This is the S&P here today, and let me center this on your screen. There we go. And let's move this over so you can see the entirety of the day. So this is the 1 minute chart of the ES. And so what happened? We had our gap, right? Market internals did not look good. This market could not take out that overnight high. And those numbers I'll post in the notes. So again, when I post those notes out in the morning, there's a lot of things that I'll post in there for ideas and different levels that I'm watching. Couldn't take that level out, chopped around a bit, and then you can see what happened. Started to sell off. And that's where we are right now as we are winding down the day. So keep that in mind. Are there sort of gaps that you know you have to buy and gaps that you know you have to short? No, there's going to be different cues, and typically if it's a momentum based idea or trigger, market internals are going to help. Ticks and put call ratios and advanced decliners and market internals are great for momentum based ideas. For exhaustion based ideas, which ceiling do I short, which floor do I buy, that's not necessarily going to be something that you can trade with market internals. It's just not typically going to happen. Okay. All right. So back over to our alerts. Now, most of the alerts are pretty self-explanatory. I would think the way that we're sending these alerts out are just really in the way in which toss, think or swim. But if you notice, we're going to buy which ETF, which expiration, which strike, and at what price. And you'll see that I'll put those out just like that. Now, what did we do today? I think this is something that a lot of the longtime members know, but if you're a new member to the futures room, yeah, do we day trade futures? Absolutely. You know, you've seen me send those alerts out. Do I love trading gold futures and crude oil futures and the indices, etc.? I mean, we're short some copper right now. Absolutely. But I know that a lot of times, especially in this environment, that's a lot of risk. You know, I was initially looking at NASDAQ shorts in the 7,900 area, 7,900. And, you know, I don't need to tell you that the market is way past that level. Think about the risk that entailed. Not everybody's going to sit through risk like that. Even though the NASDAQ typical daily price movement range is quite high, most traders are not going to feel comfortable with that. And they don't want to hold open NASDAQ futures positions overnight because it's, again, fairly cost prohibitive. Same goes for the S&P. This is a $6,600 contract overnight. The NASDAQ is even more than that. So traders have said, Rog, I really want to know how I can hold the put in the NASDAQ futures overnight, or the put in the QQQ overnight, or alternatively the XLK ETF put, or an XLC ETF put, because this is a nearly $8,000 contract. You need that margin to hold it overnight if you're going to take a daily time frame trade. Not necessarily realistic for everybody. So one of the things that we did today, we did this yesterday as well. I shorted XLK, and some traders did it today. Where's my notes? There we go. Some traders did it today and got a better price than I did, and other traders built a larger position on the cheaper price of the XLK puts. All right, but what else do we do? We got into XLF. We bought puts in XLF. We look to buy puts in. Now, not all of these are going to be so some of you looking at these prices going, wait a minute, Rog, you put your order in at the bid. Almost exclusively, I will do that. Can you split the bid ask? Absolutely. Absolutely. But I will almost always put my order in at the bid, and I will emphasize that in an environment like right now, where in many contracts, the bid ask is very wide on particular options, if you pay up, you're immediately going to be at a disadvantage. So if the market wasn't strong enough for us to get our put price, we can wait a day. It's only Tuesday. Look, this market is a trader's market. Today we kind of sold off. Who knows tomorrow what's going to pump the market higher, and who knows the day after what might dump the market lower. We don't know, right? And that's kind of where we're at. So we'll be patient, but these are still going to be levels I will continue to watch. So shorts on Germany, EWG. Am I going to short DAX futures? No, I will short the EWG ETF. Today, we had a great discussion in the chat room where some of the members said, rather than shorting gold, which we know you'd rather be long in, can we short, instead of gold at the top of the range, at the top of its distribution range, can we short GDX as well? Now, you guys know I hate GDX. I don't like GDX to the long side, but it made a lot of sense to the short side. And these are the kind of discussions that I love in the room, because I went ahead and put this trade on. I said, you know what? It makes sense. I'd rather be short this dog called GDX. A lot of traders got long this instead of gold. I'd rather get long gold, but I think it's smarter to get short the miners like GDX. So that's what we did. Canada, this is EWC. I think the Canadian story, meaning shorting Canada and shorting Canadian dollar. I love that idea, because as we're seeing this sort of optimism surrounding the OPEC meeting in crude, the Canadian dollar has been rallying with that. And the US dollar right now has been weak. So we have not only a potential Canadian dollar short against the US dollar, we also have the Canada short, which is the EWC. All right, lastly, we got into natural gas. Now, we've done the natural gas short, the UNG short, a number of times. So this is predicated on natural gas futures rallying up into the zone, and you could see exceeded it. And one of the things I pointed out in the chat room was, are we completely surprised that this happened? Because look at the previous time we were up here. And by the way, we shorted into that. But the reason we were able to withstand all of this, above the wave, is because we bought puts in UNG, and that's exactly what we went about doing again today. Okay, I never worry about taking a little bit of heat after an entry at all, because remember, what we do with the options that the expirations that are unique to the options plays, we're not face to face with time decay. I'm not dealing with time decay at the same time that I'm dealing with this momentum moving against me. So, we can be underwater just by a little bit while waiting it out and waiting for the overall trend to come back. And look, instead of trading the NASDAQ futures to the short side, we've taken XLK. Instead of trading the S&P to the short side, we're looking at XLF. I think that if I can get into SPY or ES futures puts or into NQ or QQQ puts, I might be open to that as well. But I really like the idea of XLK because we have no exposure to Amazon. All right. So I hope all this has helped. Please do check out the notes. I think they're an awesome addition to our conversation each day. Some days there's a lot of notes, some days it's not as much, but I hope each and every day helps you build a better understanding of the approach, the process-driven, repeating process-driven approach that I teach you guys and that I use each and every day. All right. Okay, gang, that's our rather long premium video, but thank you as always, and I'll see you in the next update.